Welcome again. I am doing the sacrificial thing here to keep our program going and as on time as possible by talking to you while you're trying to finish your lunch and standing here by myself while the members of my panel are finishing theirs. I was a member of my panel who started that. Thank you very much. We're here at the final panel of our conference today. Our conference, of course, is to discuss our nation's founding principles and our tax code, several aspects of them, whether they are consistent or in conflict. I did not mention earlier something that I'm very pleased to mention to you now, and that is that in our group here today, our very special group, are people that I had the distinct privilege of working with for several years. Until the end of last June, I had for 6 years been Assistant Attorney General for the Tax Division at the United States Department of Justice, a position I was very, very privileged to hold, work that I was so pleased to do, and several of my colleagues from the Tax Division are here today. And one of the reasons, those of you who are here for it, that I was able to mount that spirited defense of the Internal Revenue Service is that is what the Tax Division of the United States Department of Justice does. It defends the actions of the Internal Revenue Service and brings those actions to fruition when going to court is required to do that. They do much more than I can comment on here, but I have always been struck at the comments of largely of political candidates that they want to rip the Internal Revenue Service out by its roots, and I'm going to, to great cheers and thunderous applause, they will say, and we're going to crush the Internal Revenue Service. Largely, these are incumbent candidates who are saying this. These incumbent candidates who have actually been in a position to do something about the laws that everyone is so annoyed at the Internal Revenue Service for enforcing. In fact, there is at least one person here I know who can attest, because she was there at the time, during my confirmation hearings before the Senate Judiciary Committee in July of 2001, the chairman of the committee was reading to me various excerpts. I'm using the term various excerpts kindly. They're out of context statements that had appeared in various things that I had written, writing about the Internal Revenue laws, and some of my writing did take the form of criticism of the complexity of the Internal Revenue Code. And the senator said to me after reading me several of these snippets and asking me to explain myself, "Well, Ms. O'Connor, what would you do? How would you go about simplifying the Internal Revenue Code?" And it didn't take me a moment to know exactly what I would do. I said, "Well, Senator, the first thing I would do is run for office." And that was pretty much his reaction, and that was sort of the end of our little audition and interview up there at the Senate Judiciary Committee, because he knew that I was right, that it is in the hands of our congressmen and our senators to take the steps that are necessary to make the code something that is a little more consistent perhaps with our founding principles and something that's a little easier to live with. Complexity by itself is an undesirable trait, even just by itself, it is an undesirable trait. We have not talked today, and we are not going to talk today, as most tax policy conferences do, about whether there should be a difference between the taxation of ordinary income and capital gain income, or whether individuals only should be taxed instead of individuals and corporations and other business entities. We have not talked today, and we are not going to talk today, about whether income tax rates should be progressive or flat. We are not going to talk about whether there should be a sales tax instead of an income tax, or a value-added tax. We're not going to talk about the death or estate taxes. Our focus is very specific, and we have embarked upon it already. In our first panel, we talked about health care. I emphasize it again, as I did then, health care. How our tax laws affect how our health care is paid for and delivered. And those of you who are here for this session, know that although we spent an hour and a half on it, and we had very, very experienced individuals who have done a lot of scholarly research, an hour and a half barely scratches the surface of the issues that we could talk about and how our tax code affects how health care is paid for and delivered. In our second panel, we talked about various charitable organizations and whether, and if so, how the tax laws affect the way charitable activity is conducted, how religious institutions are governed, and the effect of all of that on free speech. There is so much more that could be said there. Mike Cannon, in the healthcare debate, thanked me for using quotation marks around the words tax expenditures, because that is a term that not everyone knows, and those who do have starkly different opinions about what it means. This panel actually could be called other tax expenditures, because panels 1 and 2 could also be considered to deal with tax expenditures. Mike Cannon, who is with the Cato Institute, has the view that most libertarians take that tax expenditures is just awful because, as a term, because it assumes that all the money that you earn actually belongs to the government and that you only get to keep that which the government lets you keep. And that certainly is a very valid viewpoint. From my perspective, tax expenditures is a good term because it is a reminder to us, and it's one of the reasons that I'm so delighted that you're all here today to talk about what tax expenditures are, because they are benefits. They are tax treatments that give some people a more beneficial treatment than others under the Internal Revenue Code. They reflect decisions that Congress has made that, as between two otherwise identically situated individuals, one ought to have a lower tax bill than the other because that first one is doing something that the government, read our lawmakers, have decided is in the best interest. One that we have not talked about today because, as tax expenditures go, it's kind of the third rail, and we're not talking about it today, but I will just mention it because everyone's familiar with it, and that is the tax deduction for home mortgage interest expense. Now, there is a prime example of how two otherwise identically situated individuals, one who rents their home and one who buys their home, have extremely different tax bills because of the preference built into the Internal Revenue Code, because our lawmakers have decided that home ownership is such a valuable quality to be promoted that it's worth doing it, and it's worth doing it through the Internal Revenue Code rather than the other way Congress would have to provide money is actual spending programs, for which they'd have to go through the authorization program and a lot more hearings than tax bills get. There is a new Chief of Staff for the Joint Committee on Taxation. Tax analysts interviewed him last October when he was very new on the job, and it was a wide-ranging interview, but I couldn't help but notice this particular statement in the interview. He said, "There is a tremendous amount of enthusiasm for spending through the tax code." That's what tax expenditures are, spending through the tax code. "There are costs in doing that," he continued. "One of the more awkward jobs I have ahead of me is sensitizing members to the costs of spending through the tax code, administrative costs, economic distortions of behavior." Now, these are not new considerations. Many decades ago, Robert Jackson, who held a number of jobs in his lifetime, he was Chief Counsel of the Internal Revenue Service, he was Assistant Attorney General for the Tax Division at the United States Department of Justice, he was Solicitor General, he was Attorney General, he was Supreme Court Justice, and quite frankly, I can't remember exactly when during his storied career that he said this, but he did say, "It will be a sad day for the revenues if the goodwill of the people toward their taxing system is frittered away in efforts to accomplish by taxation moral reforms that cannot be accomplished through direct legislation." Now, that is the topic of our conference today. Let me run right back up to the panel. You might notice that you think I've made a mistake here. I've listed Steve Entin twice. But actually, if the panel would go ahead and start moseying in this direction. Our panel today is Steve Entin, who is director of the Institute for Research on the Economics of Taxation. He is going to speak first, followed by Len Burman, who is director of the Tax Policy Center at the Urban Institute, and followed then by Professor Lily Batchelder, professor at the NYU School of Law. Steve Entin is then going to finish up, because Because tax expenditures is an unfamiliar term to many people who do not work a lot in the tax area or the tax policy area, we're going to start with Steve laying the foundation, and then we're going to go to commentary by Len Burman and Lily Batchelder, and Steve is then going to follow up. We're going to try to leave 30 minutes at the end for your questions and comments. Now let's see, Steve. There is a handout on each of your desks. Could you flip the cover there for a second? Now let me change the slide here. Thank you very much. All right, Steve.
I'm doing that later.
Oh, you're doing that the second time? Okay, well, okay, yeah, I'll just go ahead and go to Len's then. Okay, so you can keep that cover over, so you don't need one now?
No.
Okay.
Let me sit here.
Okay. Well, do you want to sit?
I don't.
As you wish. Whatever you want to do, Steve. Introduce your topics.
Okay, but I don't want to put too much junk on the computer for sending somebody's presentation into orbit. Okay. I just put together here a list of the tax expenditures in one of the tables of the the budget of the United States, Special Analysis, Analytical Perspectives, Chapter 19, 2009 Budget of the United States Government. It gives you a list of 161 tax expenditures, in case you were wondering what they were. There are some big ones up top, which we'll probably all talk about, and then there are some of the smaller ones which actually get into some of the social manipulation that we might want to talk about in some detail. I have to tell you, as I was reviewing Chapter 19 of Analytical Perspectives of the budget, I really, unless I've just had a glazed donut, my eyes glaze over on this stuff. They get into such intense discussions of theory, and unless I've just had a cup of caffeine, I can't cope. So here they all are. I have not got them memorized. I hope you find the list entertaining. Now let's get behind some of the concepts that relate to these things. There are several types of tax expenditures. There are the social policy related expenditures that attempt to redirect personal or economic behavior or support particular people as they're trying to get by in life and consume and obtain the services they need. There are others that are pure favoritism based on political clout. And others reflect a more basic consideration as to whether we are dealing with a broad-based comprehensive income tax or a broad-based comprehensive consumption tax or consumed income tax, which is a more fundamental philosophical choice. I'm going to come back to that. I'll mention some of that distinction between consumption and income taxes as I proceed at this point, but I want to go more into it later because some of the discussion in the special analyses, which focuses on specific provisions under one or the other of these systems, I think they get it a little bit wrong. They seem to be saying that, well, we can't be sure here. I think if we go through later what a very simple cash flow tax would look like, it might help you read that section of that chapter with some basic principles in mind, but that is for later, if time permits. So let me at this point give you a bit of history of these things. I have referred to in the handout Bulletin 84. This, of course, is a mistake. It is Bulletin 88 in your handout is Bulletin 84 in the real world. So if you ever do want to look up our bulletin on tax expenditures, it's IRAT bulletin number 84. Ever since the beginning of the federal income tax in 1913, there have been deductions and exclusions that cause taxable income to be less than gross income. And for example, the very first income tax return allowed for deductions for all interest paid, for state and local taxes paid, and for depreciation. Deductions are necessary in the tax code to perhaps measure income correctly, because income isn't income until you've exceeded the cost of earning the income and you have an actual profit. So costs are generally deducted and revenues are generally included. Now, economists have always been interested in these deductions and exclusions because they began to proliferate, and they do have an effect on the distribution of the tax burden, the incentive effects on economic activity, and their impact on overall revenue. But until the 1960s, there was really no comprehensive effort made to catalog the tax preferences and no standard method for analyzing them. Stanley Surrey, as you know, a professor of law at Harvard, became Assistant Secretary of the Treasury for Tax Policy during the Kennedy administration, and he believed strongly that many provisions of the tax code really resembled an alternative way of doing federal spending. They had many economic effects identical to what we spent on the budget, but they did come under much less scrutiny than the spending programs. So he thought it might be a good idea to develop a methodology where people could compare the spending through the tax system with the spending through the budget. Now, under Surrey's leadership, the Treasury began to catalog these elements, and what Surrey now called tax expenditures became the final product. Surrey clearly intended the term tax expenditure to be pejorative, undermining potential support, political support for tax preferences. He really did not like them. Now, the current tables that we see in the Treasury analysis in the budget here really began with the Congressional Budget and Impoundment Control Act of 1974, which required the President to report annually of tax expenditures in his budget. And they had a definition in the law, quote, "The term tax expenditure means those revenue losses attributable to provisions of the federal tax laws which allow a special exclusion, exemption, or deduction from gross income, or which provide a special credit, a preferential rate of tax, or a deferral of tax liability. And the term tax expenditure budget means an enumeration of such tax expenditures." It's easy to legislate, it's a little harder to do. Professor Bitker of Yale was one of the first to call attention to the problems inherent in identifying and measuring tax expenditures. First, he said there's no general agreement on what constitutes an ideal or correct tax structure to begin with, against which to determine deviations that can be considered tax expenditures. Second, he identified some problems in picking the tax-paying entity, the appropriate tax period, and a set of accounting principles. In interest of time, I won't go on with that quote. Most of the legal and economics profession since World War II has generally relied upon a definition of income for tax purposes developed by Professors Robert M. Haig and Henry C. Simons in the 1920s and 30s to determine what does and does not belong in the tax base. Simons' definition is pretty standard. Personal income is defined as the algebraic sum of the market value of rights exercised in consumption and the change in the value of the store of property rights between the beginning and the end of the period of consumption. All right, it's your consumption plus what you saved plus any capital gains and losses. Change in your wealth over the period. It doesn't pin anything down terribly well. There are a lot of things that are simply ambiguous even under that definition. And what happened fairly quickly was that Surrey decided we couldn't go with it. There were things that are inherent in that definition of taxable income that are too hard to measure or administer or calculate. He amended it to exclude, for example, which we put back in later, the imputed income on owner-occupied housing. He excludes the personal exemption, differential tax rate schedules between married and single, and the graduated rates, the lower rates than the top rate, and income splitting for married couples in the years in which we had it, and more or less explicitly. These are all deviations from a pure Haig-Simons tax base. And he argued that what tax expenditures were really designed to show is the deviation from some generally accepted normal tax base, not the variations from the theoretically unattainable Haig-Simons. Having said that, let me describe a little bit of what is available to you in Chapter 19. I'm certainly not going to go through the whole thing, mainly because I have not had enough glazed donuts and caffeine, but we don't have time for it.
Besides, our eyes would glaze over.
Yes. The tax expenditure document lays out the more or less standard list of tax expenditures that we now consider as tax expenditures. First, under the concept of an income tax. And then it goes on later to describe how it would be different if we were looking at a consumption-based tax. Within the income tax framework, it looks at two variants. One is the more or less pure Haig-Simons variant, and the other is a income variant that is closer to the income tax we all know and love, that we're used to. And in that section, they will tell you which of the two concepts they are ranking this thing as a tax expenditure under. For example, in Haig-Simons, you would have economic depreciation as your norm, and anything that accelerated you to faster write-off would be considered a tax expenditure. But in the what we're used to income tax, we are used to acceleration, so he doesn't consider that a tax expenditure. And of course, if we went to a consumption base where everything would be expensed, it would be a negative tax expenditure. Following? So actually three sets of presentations are available to you in the document. And what Treasury simply says, and identification and measurement of tax expenditures depends importantly on the baseline tax system against which the actual tax system is compared. In this document, we are patterned on a comprehensive income tax which defines income as the sum of consumption and the change in net wealth in a given period. An alternative approach would be to pattern the tax expenditure estimates on a comprehensive consumption tax. Which approach is used is perhaps the most important factor for determining what is included as a tax expenditure. For example, because a consumption tax does not tax the return to saving or investment. Actually, some of them do, and to a certain extent, which I'll clear up much later in the day. Using a comprehensive consumption tax as the normative baseline for determining tax expenditures would exclude current tax exemptions relating to retirement and education saving. Well, what they mean is pensions, IRAs, 401ks, KIOs, etc. are not tax expenditures under a consumption base. They are tax expenditures under the income base, and so on, all the way down the list. Some other things I tell you to be careful about. Don't use these lists as a revenue estimate. For example, if we start taxing capital gains as ordinary income, people may take a different quantity of gains, and you may get a very different outcome than the one calculated by assuming nobody changes their behavior. Similarly, many of these things are interactive. If you start treating corporations differently, people may switch from C to S corps. That would not be reflected in these numbers. If you have some change in the tax treatment of interest deductibility, well, how you treat the interest deduction under one set of assumptions as to whether it's a tax expenditure or not depends on how you're treating the lender. Is it taxable or is it not? If it's taxable over here and deductible over here, you're fine. If it's not taxable over here and it's deductible over here, you may have a problem. And then again, you may not, depending on what you've done with the principal. They go into that in excruciating detail, which we don't have time for here. Be aware of the fact that these things are also not additive, because if you change one, you may affect the rate involved in the other. If we raise tax rates, all of the revenue estimates on tax expenditures go up. If we lower tax rates, all of the revenue estimates on tax expenditures go down if they are involved with the rate structure. Another problem involves the concept of time and deferral. Many of these things that you find in the system involve the deferral of tax to a later date. If you look only at what happens today, you may get a very different picture. For example, if we have people deferring tax on their IRAs today by having a deductible IRA, that takes revenue out of the system now. But as IRAs build up over time, people eventually get older and they start taking money back out. And so they present things also on a present value estimate, where the future taxes are considered as an offset to the current deferral, and they discount to present value the future revenue reflow. And it can make quite a difference. The deferral of tax on controlled foreign corporations, for example, is listed as $12.5 billion under the usual method, but only $11.5 billion on the present value method. Expensing research and development, $5.9 billion is reduced to $2.6 in present value. IRA contributions fall from 9.5 to 4.3. KIO plans fall from 11 to 8.6. There's a whole list of these things in here that you can look at if you're interested. Now, even here you have no growth effects taken into account. These are all static. If these exclusions, for example, improve the tax treatment of capital, if that improves the capital stock, if that raises wages and you get income from the payroll tax and get income from the income tax from the higher salaries and so forth, or just because the corporate sector is larger and you get more corporate tax revenue, none of that is counted. These are all static. So again, you can't use them as revenues. There is a section on negative tax expenditures. In the Hague-Simons definition, you would certainly tax saving more heavily than consumption, but you would not also impose a corporate tax on it. I'll discuss that a bit later. But in one section of the document, they discuss the fact that under a Hague-Simons definition of income, the corporate tax has to be considered a negative tax expenditure. And then they discuss the fact that that is one reason why, when we lowered the tax rate on dividends and capital gains to 15%, they did not list that as a tax expenditure because it's an offset of what would otherwise be a double tax under some versions of these baseline cases. Then they go into alternative interpretations of that and so forth, and I would suggest to you that it's possible if the White House changes hands that you may get a different presentation of that one going down the road. Well, that will do it for me for this round. I hope I can leave you with the thought that a lot of this is arbitrary and very complicated, and we hope we've gotten that part of it out of the way and we can concentrate on the stuff that you'd really now like to talk about.
Thank you, Steve. Let's see, wake my computer back up. There we are. Perfect. Perfect. Our next speaker is Len Burman, who is director of the Tax Policy Center at the Urban Institute. He founded the Tax Policy Center with several colleagues in 2002. He's a visiting professor at Georgetown University, was Deputy Assistant Secretary of the Treasury for Tax Analysis from 98 to 2000, was a senior analyst at the Congressional Budget Office from 1988 to 1997, is on the National Tax Association Board and the American Tax Policy Institute Board, is on the editorial board of the Public Finance Quarterly. His PhD is from the University of Minnesota, and his bachelor's degree is from Wesleyan University. Len.
Thank you very much for that nice introduction. I'm going to set this thing up so I can try to keep on schedule.
Nasty notes from me?
Yeah, I don't want the nasty notes. So I was thinking about what the founders would think about the notion of an income tax expenditure, and I'm pretty sure their answer would be income tax. I mean, the Constitution actually didn't allow for an income tax, and that didn't come about until the 16th Amendment. Nonetheless, we have an income tax. We have tax expenditures. Some people actually have argued that tax expenditures ought to be measured against not just an income tax baseline, but against others as well. For example, there are special tax breaks under excise taxes. You actually pay less tax on microbrew beers than you do on Budweiser, because obviously Congress in its wisdom thought that yuppies needed to get additional tax breaks to overcome their other advantages. But happy to focus on income tax expenditures. I think Steve did a great job of setting up the issue. Why should we care about tax expenditures? Well, one thing, and Steve touched on this, is that virtually any spending program could be converted into a tax subsidy. David Bradford, the late great public finance economist at Princeton University, pointed out that you could basically run the Pentagon through a system of tax credits. They'd have to be refundable. Lily would like that. But you know, the problem with tax expenditures is we hide a lot of spending in the tax code, and a lot of it escapes scrutiny. And sometimes it's not the best way to do things. Also, these tax expenditures have been growing over time. It's not been a monotonic trend, but this is a chart that was put together by my colleague Eric Toder at the Tax Policy Center. And I should also note that everything we talk about here can be found on the Tax Policy Center website. If you type in tax expenditures in the search box, you'll find a whole bunch of fascinating documents. But this shows the trend in tax expenditures, not just social tax expenditures, but also business tax expenditures. And there might be some disagreement as to what should be included in those categories. But what you can see is that in the early 1980s, there was a big growth in tax expenditures. The Tax Reform Act of 1986, which was what brought me to Washington, was motivated in part by that big jump between 1980 and 1985, and that was a continuation of a trend that had started well before that. The tax code was littered with tax preferences. One of the features of the income tax until the early 1980s was that it was not adjusted for inflation. So basically income tax revenues would grow much faster than the economy as people got pushed into higher brackets. And policymakers got this wonderful windfall. If you're a politician, they could cut taxes every year or every 2 years while still increasing overall revenues. And they didn't do it by just cutting marginal rates. They created tax breaks for every every interest group you can imagine, and they built into the code. So you can see that by 1985, social tax expenditures were 5% of GDP. Now, just to put that in context, the income tax itself is only about 10%, or actually probably a little bit less than 10% of GDP back then. So the deviations from the normal income tax were worth half as much as the revenue raised by the income tax. And business tax expenditures, which included things like the investment tax credit, all sorts of preferences for particular industries, was 3% of GDP. That was cut pretty dramatically in 1986. So you can see that by and also marginal tax rates were reduced, which reduces the value of any deviation from the income tax. So it cut both social tax expenditures and business tax expenditures. And then they crept up as income tax rates were increased, and Congress introduced new tax breaks into the code. And between 2001 and 2006, the number dropped, even though there were actually additional tax expenditures that were enacted in 2001 and 2003 because of the reduction in the marginal tax rates primarily. But one thing that I think is important to note is that these are really big numbers. It's not just tiny little deviations around the edges. 7% of GDP is a lot of money. So we, my colleague Eric Toder and I actually looked at some of these income tax expenditures, and Steve mentioned the fact that you can't just add up individual tax expenditures from the budget because there are interaction effects between them. So what we did was we looked at groups of tax expenditures, and we did it just on the individual side because we could do that using the Tax Policy Center's model. And actually what you can see is that the difference between just adding up the individual tax expenditures, which came to $710 billion for the things that we could measure in 2007, was not hugely different from what it would be when you account for the interactions. And generally the reason the interaction produces a larger number is that if you got rid of some tax expenditures, it would put people into higher marginal tax brackets, and that makes the value of the remaining tax expenditures even bigger. But again, what you can see is that these are really big numbers. The first line, which is called exclusions, includes the income tax expenditure for employer-sponsored health insurance. That is, if your employer pays for your health insurance, it's not included in your income. And the other big items are for pensions and 401ks. And they come to more than $325 billion in 2007. If you actually had a public program that was spending that much money, presumably it would be subject to a lot of scrutiny. And as I'm sure you discussed earlier today, the exclusion for employer-sponsored health insurance has a lot of deficiencies. It's basically a subsidy for which the largest benefit goes to the highest income people who most likely have health insurance anyway. And the people who most need help in paying for health insurance get little or nothing from it. The same is true for pensions. If you want to encourage people to save, ideally, you probably want to especially help people for whom saving is really hard, and that's not the people earning $250. Just have a session just on whether that should be a tax expenditure or not. I'll just note that it's a lot of money. It's $100 billion, $50,000 a year. Capital gains and dividends, Steve and I could have an argument just that we could just compare, and that's just the difference between taxation of capital gains and dividends and other income. Itemized deductions is where a lot of special tax breaks are, and I'm going to talk about those in detail in a second. One thing you'll notice is that when you account for the interactions, they're actually smaller than the sum of the parts. Non-refundable tax credits includes things like the tax breaks for higher education, child independent care tax credit, it's $11 billion, and refundable tax credits, which are the earned income tax credit and the child tax credit, which are work subsidies, I think Lily's going to talk about, are significant. They're over $89 billion in 2007. Now, itemized deductions are a special category because if you got rid of some itemized deductions, it would actually reduce the value of the others. It might seem a little bit counterintuitive, but suppose you got rid of the mortgage interest deduction. A lot of people would stop itemizing deductions, and at that point, their state and local tax deduction wouldn't be worth anything to them. Similarly, if you got rid of the state and local tax deduction, the mortgage interest deduction would be worth less. But these are big numbers. We spend, in 2007, $80 billion on the mortgage interest deduction, $76 billion on the deduction for state and local income taxes, sales taxes, and property taxes. And this particular deduction has been getting more scrutiny lately because people have thought about this as a way to pay for getting rid of the dreaded alternative minimum tax. It's considered to be the subsidy for state and local governments, but it's a really ridiculous way to subsidize them because the states that get the biggest subsidies are places where a lot of people itemize. Most people don't itemize their deductions. Most people take the standard deduction, and where people are in high marginal tax brackets because the value of state and local tax deduction is worth a lot more to you if you're in the 35% bracket than if you're in the 10% bracket. So basically this subsidy is mostly going to people in states with really big income tax bases, which maybe doesn't make that much sense. The charitable deduction, that's sacrosanct, and actually that was in the law in UK back in the 1800s. The others are relatively small items. This shows that tax expenditures as a percentage of after-tax income, and it's one measure of how they affect the progressivity of the tax system. One of the goals of the tax system is to try to raise the tax in a relatively fair way. And most people think that the share of taxes paid as a share of income should increase with income. What you can see is that most of these subsidies also increase with income. That is, that they undermine the basic progressivity of the tax system. That means the rates have to be more progressive than they would be otherwise to maintain whatever targets of progressivity you have. It also means that they're not particularly, if you're actually trying to encourage people to do things, they're not particularly well targeted to where the needs are. You can see that the exclusions, the largest benefits go to people in the top quintile, 4.7% of income. It's actually a smaller share of income at the very, very top, the top 1%, and that's because pensions and health insurance are a relatively small part of income for people who are really rich. The itemized deduction, similarly, the mortgage interest deduction, which is the biggest of those, goes primarily to people with relatively high incomes, 2.9% of income at the very top, nothing to people in the bottom because most of them don't actually owe income taxes and most of them don't itemize either. Refundable credits are the one exception. These only benefit people who don't have income tax liability after the non-refundable credits, and there's 5.5% of income at the bottom and virtually none at the top. And overall, you can see that the combination of all these tax expenditures provides the largest benefits to people at the very, very top. And that would be true even if you took out capital gains and dividends, which, as I noted, not everyone would agree should be treated as tax expenditures. There's been a criticism of the concept of tax expenditures, which Eileen touched on, and the idea is that there's this kind of liberal bias built into the notion of a tax expenditure. And Bruce Bartlett, in a paper he wrote in 2001, said the current methodology creates a bias in favor of liberal tax policy. And what he meant by that was that the tax expenditure baseline was an income tax. So things like dividends and the tax breaks for dividends and capital gains, the subsidies for 401ks and pensions, all of which would exist under a consumption tax or would be even bigger under a consumption tax, are treated as tax giveaways under a tax expenditure baseline. The response to that is that Treasury now produces estimates relative to different baselines. And one thing you'll note is that most of the tax expenditures on Treasury's list apply whatever baseline you use. I think Steve's going to talk about this a little bit more. There's a criticism. This is Jim Saxton, who was the Republican chair of the Joint Economic Committee in 2002. He said the tax expenditure concept relies heavily on a normative notion that shielding certain taxpayer income from taxation deprives government of its rightful revenues, which I'm sure he thought was a new insight, but in fact it was an old one. This is Sir Strafford Northcote in 1867. He was debating Lord Gladstone, who said we should try to figure out how much, what's happening to all these deductions people are taking for charity. We wouldn't have a public program where we spent £5 million on charity without some kind of scrutiny, but we've got this tax break and nobody's paying any attention to it. And Sir Strafford Northcote said, the right honourable gentleman, if he took £5 out of the pocket of a man worth £100, but the case is if he gave the man £95. It's the same argument Jim Saxton made. The fact is that we actually need to raise taxes somehow or another. And these deviations from the tax system mean that tax rates have to be higher than they would otherwise. And as I noted, most of these things actually most of these programs are essentially spending programs that are run through the tax system. They would be subject to scrutiny if they were run through a direct spending program. They have exactly the same effect on resource allocation. They have exactly the same effect on what tax burdens need to be overall. And you should, I think conservatives and liberals should care about it. Any direct expenditure could, in theory, be redesigned as a tax expenditure. And in practice, they're often less efficient. This is from a conference we did called Stupid Tax Tricks. And this is a sign, chicken poop $3.99. You might wonder what that has to do with tax credits. There's actually a tax subsidy for energy made with chicken poop. Section 45 of the code, it now includes other kinds of poop as well. But basically, it's a subsidy for burning manure to make energy. This sounds like, well, maybe it's an environmentally good thing to do. Well, I think it's a stupid tax trick because the reason this was put in the code is because Senator Roth of Delaware, where there are a lot of chickens, noted that his farmers had to, take all of their manure and put it into these power plants to get rid of it because of environmental restrictions, environmental laws. It was basically the most environmental thing they could do with it, the cheapest way they could meet the environmental mandates, and it was costing them money and they didn't like it. So he created this tax subsidy to subsidize what they were doing anyway. There are a lot of stupid tax tricks. There's been a lot of discussion lately about the idea of a temporary gas tax holiday. And I've been talking about that some. This is great. There's bipartisan consensus. Senator McCain and Senator Clinton think we should suspend the federal gas tax for the summer. Well, whether or not you think a gas tax is a good idea, suspending it for 3 months is going to do almost nothing to prices because the supply of gasoline is pretty much fixed over the short term. So what economics tells you, if the supply curve looks like this, the price is going to pretty much be determined by demand, whether or not you have a tax. So basically, it's just a windfall for refiners, for Venezuela, which exports gasoline to us, and very little benefit to consumers. But it makes a great soundbite. There are a whole bunch of others, education credits, clean coal tax credits, that's a great oxymoron, low-income housing tax credit, the mortgage interest deduction. And the point is that they should be subject to scrutiny. Now, the other thing is that tax expenditures, whatever your baseline, provide a measure of economic distortions. The variations in tax expenditures among different activities are related to incentives to create tax shelters. For example, there's a disagreement about whether you should tax capital gains or not. And that the fundamental basis of that disagreement is about whether you should have a consumption tax or an income tax. If you had a consumption tax, you wouldn't tax capital gains, you wouldn't tax dividends, you wouldn't tax interest, you wouldn't allow deductions for interest expense. But under an income tax, when you allow a deduction for interest expense and you tax capital gains at a lower rate than ordinary income, you create a huge incentive for converting ordinary income into capital gains. And that produces an economic cost. You might judge that the benefit from subsidizing those kinds of investments is worth it, but there's definitely a cost. If this was a room full of tax lawyers, they'd all be shaking their heads like this because that's what tax lawyers do. They figure out how to convert ordinary income into capital gains. And most of the things that they do to do that don't provide any benefits for the economy. I mean, there are two losses. One is the people who are figuring out how to do this actually could do socially productive work otherwise. Like figuring out how to produce cars we could sell at world markets. The other thing is that most of the investments that produce these tax shelters are really dubious quality. And one of the basic principles of the tax system is you shouldn't be channeling investments into activities that don't produce a normal rate of return. Bottom line, I actually don't even, no, yeah, I do have a slide for this. There's a huge opportunity cost of tax expenditures, over $700 billion just from the social tax expenditures in 2007 alone. And the money could otherwise be used to do various things. You could cut the top tax bracket to 20% from 35% right now on a revenue-neutral basis if you got rid of all tax expenditures. I would say you wouldn't want to do that because some of these things actually would survive scrutiny. There are things we do through the tax system that are probably the most efficient way to provide the services, but a lot of them aren't. You could eliminate the budget deficit and actually run a surplus. You could provide national health insurance. You could invest in infrastructure, make sure bridges don't collapse into the river. The point is that tax expenditures impinge on both liberals and conservatives' priorities. It's kind of like this deal with the devil between Democrats and Republicans, that they can't agree on new spending programs because the Democrats get tarred as tax and spend liberals. So instead they agree to do these programs through the tax system that don't work. But they look like tax cuts, so everybody's happy.
Excellent. You can have your watch back. That was terrific, Len. Our next speaker is also terrific and terrifically qualified to be speaking to us today. Lily Batchelder is Associate Professor of Law and Public Policy at New York University. She received her A.B. in Political Science from Stanford University, her Master's in Public Policy in Microeconomics and Human Services from Harvard, and her J.D. from Yale Law School. She has published a lot and testified a lot. I will mention just a couple of things. A paper she wrote in 2006 was entitled Efficiency and Tax Incentives, the Case for Refundable Tax Credits. And last year she testified before the Joint Economic Committee titled Household Income Volatility and Tax Policy, Helping More and Hurting Less. Welcome, Lily Batchelder.
Thanks, Lee. So what I wanted to talk about now that we've heard all this dreary stuff about tax expenditures is what we can do to reform them. And I wanted to start out just with a little background about different rationales for tax provisions, because these sometimes get mixed up, I think, actually within the debate about tax expenditures, and the word is used a little loosely. So there are three different reasons why you might want to carve something out of a tax base. So it could be an income tax base, it could be a consumption tax base, it could be the payroll tax, the excise tax, the corporate income tax, a wealth tax, which many countries have. And the three reasons are, first, that it might be income measurement. So, for example, a deduction for business expenses is a pretty normal reason why you'd want to have a deduction. Another would be ability to pay. So the standard deduction, our marginal tax rates being progressive. And then the third is if you want to have an incentive for some kind of behavior. And that's what I really want to be talking about when I'm talking about tax expenditures, or I'll call them tax incentives to try to be a little more precise. I generally will also be talking about an income tax baseline, and I do think it's worthwhile to think about different baselines. That said, I think that so long as Len was getting into the point that there are real problems when you have deductible interest and you start exempting the returns to capital income. And I'd have to sort of teach half a class to explain why. But as long as we have an interest deduction, I think we are in an income tax world, and it makes sense to be looking, using an income tax baseline in terms of figuring out what tax incentives we have in the code. If we started repealing the interest deduction, then it might make sense to view something like 401ks or IRAs not as tax expenditures, and in fact it would begin to make sense to move to a consumption tax and not tax capital income at all. We haven't made that decision yet, so I think it makes more sense to use an income tax baseline, but we can certainly talk about that. So in terms of these three rationales, I don't think anybody really has any quibbles with trying to measure income accurately or measure consumption or wages, et cetera. Ability to pay is certainly, a very contested issue, and we could talk a lot about what principles this country was founded on in terms of ability to pay, whether it's about respecting property rights regardless of how they were derived, or whether our founding principles are about ensuring that everyone starts with a level playing field, or ensuring against some risk of being low skill. I don't think we're going to resolve those philosophical issues, and it's not really the subject of the panel. So I wanted to focus on this third of tax incentives. And the way I see it, we have three options for reform of them. We can either expand them, create new ones, replace direct spending with tax expenditures. We can restructure them, which is what I'm going to spend a lot of time on, or we can repeal them. And repeal might involve replacing it with a direct spending program, or it might involve eliminating the incentive entirely. So in terms of thinking about what the best approach is, I think it's first helpful to just think in terms of how you would like a subsidy to look, regardless of whether it's a tax expenditure or a direct expenditure. And that really depends if the goal is here to try to induce some kind of behavior that we think has social benefits. It's going to depend first on what the social benefits are from the activity, so how big they are, if they sort of vary by your demographic group. It will also depend on how responsive people are. So if they're entirely unresponsive to financial incentives, it doesn't make a lot of sense to have a tax incentive. There's also an issue that tax people call buying out the base, where if you're going to have a tax incentive to engage in certain behavior and people already do a lot of it, then you're going to be buying out the base in terms of subsidizing a lot of existing behavior often before you start hitting their marginal decisions. And then the last issue is transition costs. So there may be some tax expenditures or subsidies in general that we think are wrong and don't make sense, but to the extent that they're capitalized into prices, that might be an argument for retaining them. So one way you could think of this is the home mortgage interest deduction. If that is perfectly capitalized into the prices of homes, and people are capitalizing it, assuming it's going to last forever at the same rate, then when it was first enacted, you had this windfall to existing homeowners and landowners. But if you repeal it, you just have a one-time levy on existing homeowners and landowners, which doesn't make as much sense. I don't personally think incentives are perfectly capitalized into prices, but that would be one consideration in terms of the ideal subsidy. So once you figured out what kind of subsidy you want, I think then you get into this debate of should it be in the tax code or should it be a direct spending program. And there are a bunch of different considerations in terms of which would be best. So one is economies of scale. And I guess I'm going to play the role a bit, which feels awkward because I'm not a fan of a lot of tax expenditures, but the role a bit of the defender. I do think that there's a sense of viewing tax expenditures as wholly evil because it kind of clutters up our tax code, and there's a way in which tax people have a sort of not in my backyard approach of don't put all that complexity in my beautiful tax code. But if it's going to be there as a direct spending program, it's going to be complexity somewhere. So one consideration is kind of where are the economies of scale. And if it's an incentive that really relies on income information that you want to pay out annually, you may actually most efficiently administer it through the IRS. If it's something that relies more on non-income information, maybe you want to provide it in kind, that might be a reason for a direct spending program. Another justification, especially if it's an incentive targeted on low-income people or lower status people, is stigma costs. Generally, if you're filing for a tax incentive, there's not a lot of stigma. If you're going to the welfare office, there is stigma. Another is transparency. So one argument that could be made is that spending in the tax code is less transparent, and that sort of violates our democratic values. There's a question of, maybe people certainly are aware of the home mortgage interest deduction, so some of these things are transparent, but there are sort of pros and cons of it being in the tax and spending system. So one problem we often face policy-wise is when you have an incentive or program phase out, you create really high marginal tax rates for people. And if you lump everything together in the tax system, it does become a bit easier to see those interactions and where they're creating very perverse incentives for people. But obviously, one can make an argument that direct spending is better on the transparency grounds. So based on all of this, I don't really think for these first reasons that there's a systematic reason to oppose tax expenditures. It really is going to depend on what exactly you're subsidizing, where the economies of scale are, et cetera. The only two really systematic reasons I see for opposing tax expenditures are more sort of political economy reasons. So one would be that the use of tax expenditures results in more spending. And it's basically a hidden way of spending that liberals tend to support tax expenditures because they can expand social programs they like, and the conservatives like them because they're shrinking the size of government, because generally a tax expenditure is a tax cut, so they love tax cuts. This argument for me sort of comes down to the idea that conservative voters are being duped. So they're thinking that they are shrinking the size of government by cutting taxes, but actually they're enacting a new spending program in a different form. The other sort of general argument for systematically avoiding tax expenditures, I think, is that there's a bias when you use tax expenditures towards structuring them as deductions or exclusions. And Len has described what these are a bit, but I will as well. And that this results in systematically poorly targeted subsidies, because that is not a good way to target a subsidy. And I actually, sort of the main point I want to make is that I think this is the biggest reason to oppose tax incentives as opposed to direct spending programs. And the solution in my mind is first either that we should restructure existing tax incentives where there are social benefits into some kind of refundable tax credit, or we should just repeal them. So if we don't think we can politically move towards some kind of refundable tax credit, we should just get rid of these, because there's really no coherent rationale to have a tax incentive structured as a deduction or exclusion. So why refundable tax credits? So this is just sort of a reminder of what Len went over. Deductions or exclusions, the value is the amount deducted or excluded times your marginal tax rate. For a non-refundable tax credit, the credit equals the credit, so it might be a $1,000 credit for higher education, or it might be X percent of your spending on higher education. It just equals that amount, and it is only to the extent of your tax liability. So if you have no tax liability, no non-refundable credit. A refundable credit does not impose that restriction. So the amount of the subsidy is just the credit. And it doesn't vary by your marginal tax rate. It doesn't vary by whether you have any positive income tax liability. This matters in my mind because there are an awful lot of people these days who don't have positive income tax liability. They generally have positive federal tax liability because the payroll tax is now a larger revenue drain for most households than the income tax. But about 35 to 40% of households have no income tax liability. About 50% of households with children, to the extent we're talking about a tax incentive for something related to children, about 60% don't have positive income tax liability at some point. So a lot of us, unless you're a tenured professor, tend to have a lot of income fluctuations. And especially people that are sort of middle and lower income, their income tends to fluctuate very widely. So they may for many years be paying taxes, and then one year have a bad year and they pay no taxes. And in that year, they not only have lower income, but they have less incentive to engage in whatever socially valuable activities they're engaging in. So unfortunately, right now we mostly have tax incentives structured as deductions, exclusions, or non-refundable credits. These were just some calculations I did off joint committee data. I think Len's estimates suggest that only about 10% of our existing individual tax incentives are structured as refundable tax credits. So we're really generally using this system of deductions, exclusions, and exemptions. The only real exceptions are something called the Earned Income Tax Credit and the Child Tax Credit. And the result of this is that people face really different incentives. So I just put up a hypothetical of a married couple with 2 college-age kids who aren't dependents, and they're engaging in all of these things that we deem to be socially valuable in some way. So they're paying, well, probably their employer is paying for their health insurance. They're paying about 15% of their income in home mortgage interest, about 8% for retirement savings, 8% for higher education for their kids, 3% for charitable contributions. And if this couple is earning $15,000, so say, one of them's working a minimum wage job, the other kind of fluctuates in and out of employment in a minimum wage job, they face zero incentive to engage in any of these activities under current law because they are structured as deductions, exclusions, or non-refundable tax credits. The couple with $50,000 generally faces, they're in the 15% bracket, so for most of these they get a 15% incentive, and they have a total incentive for all of these of about $7,000. And then the couple earning $500,000 has a total incentive of $49,000. So you can see these differences pretty dramatically here. And it's not entirely clear to me in this case why we should value, for instance, a higher income married couple owning a home more than a low income couple, but they are getting a much bigger incentive to be a homeowner. So the problem with this, first it looks pretty unfair, but I actually think more importantly it's inefficient and doesn't make sense. So I'm less sort of concerned about the progressivity effects here and redistribution, but just that if we're trying to promote sort of certain behavior, this is a really bizarre way to do it. So for one thing, I would think that the social benefits of sending kids to college, or what kind of incentives you'd want to place and have the government put into place, you would want them to be the same regardless of how high or low income a couple is, or potentially you might want to have them be larger incentives for a lower income family who's less likely to send their children to college. Similarly, the responsiveness of the lower income household is probably going to be the same or larger, and you're going to have less of that buying out of the base problem. And most importantly, I think there's absolutely no reason to think that social benefits and the responsiveness vary and make abrupt changes right at the point of the tax brackets. So why do we think that exactly at the point where you reach zero income tax liability, suddenly you're not going to be responsive to a tax incentive, your behavior is not going to produce any social benefits? That just doesn't make sense to me. So that's why I say it has to be the right answer that it's some kind of refundable credit. Maybe you could say it should be a regressive one, and it should be a larger incentive for higher income people because they're more responsive. That's fine, but it doesn't make sense for it to be a deduction or exclusion. So the takeaway about this is that we're really spending a huge amount of money through the tax code in very nonsensical ways. So these are, I'm stealing from Len, these are his estimates of individual income tax incentives. And we have the income tax revenue is about $1 trillion, and we have about $750,000 of tax incentives. So the way in which you could argue that the conservative public is being duped is that they're viewing this as great. We're shrinking the size of government because we cut taxes by $750,000. Actually, the size of government is $1.75 trillion, and we're just delivering $750,000 of spending and incentives and distortions through the tax code rather than through direct spending. So just to sum up, I think the solution here is that if there are social benefits present, we should be restructuring tax incentives as refundable tax credits with some form. It may be progressive, it may be regressive, but it should be a refundable tax credit. We can get a bigger bang for our buck, I think, with these incentives. First by possibly targeting them by demographic groups. So again, if we know a certain demographic group, there's more social benefits, they're more responsive, we might want them to target them that way. On the other hand, I think there's something to be said for uniformity. So my favorite example is I had a student write a paper on the hybrid car tax credit, which had a pretty bizarre structure. It was depended on the vehicle, and then it was sort of the first $500,000 vehicles sold in the US because they were worried about Toyota getting too many subsidies. And she called up a bunch of car dealerships and said, okay, I'm interested in a Prius. What are the tax benefits? And not a single one of them would answer her. They all referred her to the qualified New Jersey tax professional. So to the extent, and there actually was a $4,500 subsidy. So to the extent that we want this to be an incentive and to work, if it's uniform, that car dealership could have just said you get $4,500 if it was a refundable tax credit. Because it wasn't refundable, because it was only their first 500,000 cars, they weren't able to say that, and they had to refer her to an accountant. Len reminds me it's also an AMT preference item. Another way you could get a bigger bang for your buck is through a floor. So this was actually something proposed by the President's tax reform panel. To the extent that, say, most households contribute 1% of their income to charities, we could have exempt from the incentive the first 1% and then have a larger incentive thereafter. So we'd be hitting more of their marginal decision. Another is to make a matching contribution. So people tend to treat a match or respond better to a match than a tax incentive that they personally receive. So one way to think of this in the charitable context is if you have a one-for-one charitable incentive, those challenge grants where they say on the radio, if you contribute $1 today, this foundation will match you $1. People respond better to that than if you say, if you contribute $1 today, we'll give you 50 cents back. And they're actually the same thing economically, but it sounds different. Another is to use defaults if we really want to get people to engage in certain behavior that we think is socially beneficial. If we aren't going to do any of these things, then my solution would be just to repeal tax expenditures. So if we're not willing to restructure, if there's been a lot of opposition in Washington to the idea of refundable credits, if we're not willing to put those in the tax code, then I think we do reach the results of let's just get this out of the tax code, put it in a direct spending program where hopefully people will not be constrained by this deduction and exclusion conception of how to structure a subsidy. Thanks so much.
And thank you. Thank you, Lily. And for our final speaker, a repeat performance by Stephen Entin, who I did not tell you all about earlier. Stephen, I mentioned, is the director of the Institute for Research on the Economics of Taxation. I didn't tell you, I don't think, that that's a free market It is a think tank that focuses on research in support of free market economics. Steve was Deputy Assistant Secretary for Economic Policy in the Reagan administration. He also served on the Kemp Commission, which was that National Commission on Restructuring, for Economic Growth and Tax Reform, which focused on tax restructuring. He's a graduate of Dartmouth and did graduate work in economics at the University of Chicago. For a few final comments, I'll have a few final comments after that, then we're going to have some, I hope, time for questions and answers, so stick around.
Thank you. I'd like to go very briefly a little bit more on the concept of the income versus the consumption base. The key point here is that before you label something a tax expenditure, you have to know as to whether or not you've defined income correctly. Many of the things we list as tax expenditures actually reflect costs because saving isn't a free lunch. If you want to get interest and dividends, you have to give up some principal, and you can't use it for a while. And in our brains, we have a sense of the time value of money. And then there's also the problem of inflation. So we have got to get the tax base right before we call something a tax expenditure. I want to show you why economists are debating the difference between an income and a consumption base. When you earn your income, you pay your tax on it. If you use it for consumption, unless you buy gasoline or tobacco or liquor, and a few other odds and ends like arrows and ammunition and tackle boxes, there's no excise tax. There's no other federal tax on it. So you earn your income, you pay your tax, you use it for consumption, you're fine. You can buy a loaf of bread and eat it, and we don't bother you. You can buy a TV, you can watch the stream of programming, and we don't bother you. However, if you buy a bond, we tax the interest. If you buy a share of stock, we tax the dividends, and if they reinvest for you, we tax the capital gain. These second layers of tax on the returns on saving are not present on consumption. And that is the basic income tax bias against saving. Now, there's a third stage, which is if you buy a corporate share, there's the corporate tax before you even get the dividend, or the retained earning gets reinvested for you. That's a third layer of tax, and even one that Henry Simons couldn't tolerate. And then, of course, there's the death tax at the end. So this is the basic set of biases against saving in the tax system. Now, the neutral tax systems, the VAT, the sales tax, the consumed income tax, the old Nunn-Domenici bill, the current English bill, the flat tax, what do? They peel away these extra layers. They don't have the death tax. They do tax income that is inherited if you spend it, but as long as you continue to save it, it's deferred. They don't have a double tax on corporate income. You either tax it at the shareholder level or at the corporate level, but not both, which is why you have that whole section in the Treasury document on how they treat some of the offsets to the double tax and why they don't count them as tax expenditures. On the basic tax bias against saving, we have a couple of ways around it. Either you defer the tax on the saving, as in a deductible IRA or a pension, and then we tax it when you take it out. Or you put in the after-tax money as in a Roth IRA, and we don't tax the returns. That gets you back to tax neutrality, equal treatment of consumption and future consumption, in a sense. Why does it matter? Capital is highly responsive to the rate of return after tax. If you pile these added taxes on it, the capital stock shrinks, the productivity of labor goes down, the wages go down, and what ends up happening is that most of the burden of taxes on capital are passed on over time to labor. And there's a whole new literature on how fast that works. We used to think it took a long time. We no longer think that. So you've got to get the base right before you call something a tax expenditure. And of the 30 largest tax expenditures we find in the Treasury document, over half of them relate to this problem of why we need to defer the tax on saving and why that is not truly a tax expenditure. The analogy on equipment and structures is that when you buy these things and you depreciate them over a long time period, the present value of the write-off is eroded by inflation and the time value of money. We'll skip this one time. And you all know about the double taxation of corporate income. These charts are available on the taxation of income and the issue of tax reform, which is a paper on our website. I won't have time to go over all of it. But you have a fairly high tax rate on the double tax situation on corporate income, which we have lowered after the 2003 Act, which is about to bounce way back up again in 2011. This would have a serious effect on investment. This is what I mean by the time value of money. This is the depreciation chart. If you have expensing of 3, 5, 7, 10, 39-year assets, you write off $1 for every dollar you spend. The present value, however, at 0% inflation of a 7-year asset is that the write-off of $1 drops in value to only 91 cents in present value. If you're earning 9% on the machine over its life, and we pretend it only cost you 91 cents instead of $1, we're taxing you on 18 cents instead of 9, which in effect doubles the corporate tax rate. And at higher rates of inflation, you can get things where, situations where corporations are being taxed when they have had no real income. And that is why we talk about expensing versus depreciation in a consumption-based tax. These effects can be very, very large. I have an example here where I've doubled the tax and effectively doubled the tax rate and halved the rate of return on an investment. And again, capital is responsive to this, and that's a bad thing. A consumption-based tax need not be a VAT or a sales tax. We heard a minute ago from Len that there is a problem, and from Lily, that there can be a problem when you have a deduction for the interest and something's going on the other side and people are changing things into capital gains and so on. You don't have to have a consumption tax where this is a problem. Usually you have such a problem where you're halfway between one sort of tax system and another. If you get into any of these things, they're internally consistent and those problems are prevented, which is why it's necessary to have someone over at the Congress taking an overview of this thing to see if the steps are being taken in an orderly fashion. Let me go through a very simple consumption tax, a cash flow tax, that might help you get through the Treasury document. This is an individual tax. It's not the sort of army tax where you have the income being taxed at the business level and the expense. You do expense here only if you are a small businessman and you're actually buying machinery. But generally speaking, you put down all your labor compensation, including your Social Security and any transfer payments you get from the government. You have your basic income up at the top. You will subtract any net saving you do. It's deferred. Everything gets the sort of treatment you get in a deferred IRA or a pension plan. Not just some saving, not with caps, not at certain ages, not for this, not for that. All saving gets a deduction. Here's your taxable income. There are itemized deductions, which I'll get to in a moment. You subtract them, you have a personal allowance, and you're done. What would be a deduction? The flat tax disallows some of these things, and I'm going to try to convince you it's a mistake. You would deduct your state and local taxes and other taxes paid. Why is that? Bradford tried to say that you only deduct those taxes where you don't get anything back for them. If you have your property tax, your local taxes, or your state government taxes, you're getting some services back, so that's consumption. We ought to really tax that. We should get rid of the state and local tax deduction. No. Think about alimony. I should offend, I hope nobody in the room, but if someone is paying alimony to someone else, it comes off that person's tax return and goes on to the recipients because they get to consume it. It's transferred from them to them. That measures income properly. My income measures properly. The recipient's income measures properly. Well, when the property tax or the state income tax is taken from you and given to someone else, it comes off your income, it should go onto theirs. If I want to give to charity, it should come off my income and go to the recipient. If the recipient is then too poor to owe tax, so be it. We've made that decision. We don't want to tax the very poor. Now, what about the property tax? Well, first of all, investment is expensed. If I'm buying a cash register for my business, I expense it. If I buy a truck for my trucking firm, I expense it. If I buy myself an education so that I can earn future income and that future income is taxable, the tuition should be deductible as a business expense. Not because I'm trying to encourage education, but because it's necessary to earn income. If I also want to encourage education for the poor beyond that, I should have a voucher for them. But I shouldn't tamper with the fact that I should have a deduction, not a credit, for education, because that's how you measure income correctly. And then I can give a credit or a voucher in addition to that to handle the problem of low-income people I'm trying to encourage. You see, these deductions are not simply to give incentives or to nudge people to do this or that. They're designed to measure income correctly. So tuition should be deductible. Gifts should be deductible and go on to the returns of the people getting them. Those are my itemized deductions. There are not many, and there's a good reason for them. So the flat tax should not throw them out just to lower the rate. Now, what about saving? We don't have to worry about capital gains, inflows and outflows, and what I spent my money on, and whether all you get is a number from your broker at the end of the year saying you either added to or subtracted from your account. So if you've saved, you get a deduction for it. If you've taken money out or borrowed, you have to add it back in. And when you do these rules consistently, virtually all of the possible loopholes for playing with capital gains or doing this or doing that are simply eliminated. They can't function in a system that's this coherent. What about the corporate tax? It would not be here. Your corporation is a great big IRA. I buy a share of stock, the company invests it and grows it. When I sell it, I pay tax. What about the foreign tax situation? This is territorial. If I take money out of the country, it's like withdrawing it from a savings account. I'm going to tax it at the border on the way out. And whatever happens overseas, forget it. I don't care. I don't have to worry about any of that nonsense. Which, by the way, does help our firms to compete overseas. We don't want to just eliminate deferral. This sort of cash flow tax, if you think about it, can guide you through the Treasury discussion and confusion over the mortgage interest deduction, over the education credits, over many of the other things in there where they say, well, we're not sure whether this is really a consumption tax, tax expenditure or not. It depends on how you look at it and how you look at Social Security and so forth. There are about 8 pages in there where they're not sure. Under either system, income or consumption, how do you treat Social Security? How do you treat the home? When you do something like this, you have a much better guide as to how to work through these issues than if you just look at the Treasury discussion. And I just, in the interest of having questions, I will...
Don't close that.
Don't stop that. Okay, I will stop my slides. One comment, if I may. There is something odd about refundable tax credits I think we should be aware of. A lot of economists are worried at the margin as to whether the decisions are right or wrong. I'll give you actually 2 instances. If we have expensing of plant and equipment, should I be allowed to deduct my interest? I've already expensed the machine. Should I deduct the interest too? If the recipient of the interest is taxable, then yes, because there's no net tax change over here. Nothing wrong with that. But some economists look at things on the average, and some attorneys look at things on the average. Some lenders are tax exempt. Jane Gravel comes out with a tax subsidy because some lenders are tax exempt if the business deducts its interest expense, and if they're tax exempt, you have a negative tax on the investment. These aren't the marginal lenders. Harvard can't automatically demand, by its changing its behavior, to suddenly enlarge its endowment and do more lending on a tax-exempt basis. The Red Cross can't take its little pool of saving and suddenly enlarge it. They depend on donors. People in the IRAs, they're capped. They can't suddenly do this. The tax-exempt portion of the lending situation is pretty well capped. The marginal investor is almost certainly a foreigner or an American subject to the ordinary income tax rules, and he's going to be taxed on what he's getting, so if the firm pays me my interest and I pay tax on it, he gets a deduction, not a problem. On the refundable side, it's very interesting. You know, we have a problem in that something like only 3% of the income tax is paid by the bottom half of the income distribution, and over 44% of the families don't pay income tax. And we begin to think that maybe government's a free good, and we have this tipping point where we have too much government because people think it's a free lunch. Actually, that may be true where you have non-refundable credits. Someone's down to zero on his tax and has left $2,000 in credits on the table he couldn't take. If we were to raise tax rates, he wouldn't be concerned until his tax had gone up by more than $2,000 and he was suddenly in positive territory. In between, he wouldn't care. But with a refundable credit of a fixed amount, if taxes go up, his tax liability goes up and he gets less of a refund. He still at least sees that at the margin, this program that was spent upon and taxed to finance wasn't a free lunch for him. So when you do have your social goal and you are trying to, in addition to defining income properly, also give something, let's say for education, the refundability is not something conservatives should be concerned with. It might actually help the situation as far as the political economic situation is concerned. Thank you.
Thank you, Steve. We are almost ready for questions and answers, but let me just tee up something else that I think you will find amusing. We talked about that. All right, see if any of you recognize this. It will be of little avail to the people that the laws are made by men of their own choice. If the laws be so voluminous that they cannot be read, or so incoherent that they cannot be understood, if they be repealed or revised before they are promulgated or undergo such incessant changes that no man who knows what the law is today can guess what it will be tomorrow. Gosh! Do we have a prize? Very good, very good. There it is. There. Well, you've heard a lot today. We did talk about things I said we weren't going to talk about, but we didn't debate them. They just naturally come up in the context of talking about the structure of our Internal Revenue Code, which at this point includes tax expenditures, which, as Steve so elegantly pointed out, depends on whether something is a tax expenditure, depends on how you define the baseline. And there are all sorts of proposals about how to change that. Given that, let's have a round of applause for our panelists. And let me have somebody at the microphone here to ask the question. See, you guys just boggled their minds. Boggled their minds. There we are. I knew there was one.
Hi, I'm a tax lawyer, Charlie Wong. I'm in town. For Professor Batchelder, 2 practical points. Given the fraud problems with the earned income tax credit, wouldn't more refundable tax credits cause more fraud problems? 2, aren't you really overestimating the extent to which tax provisions are understood by the general population, especially people that you're trying to incentivize? 2 cases in point. One on the hybrid thing. I bought a hybrid. So I could drive in the HOV lanes. And my dealer told me, you get a tax credit for that. And I said, well, are you sure about that? He said, yeah, it's a tax credit. But it wasn't. It was a deduction. So he completely screwed that up. Second, my firm takes advantage of the transportation credit, a low amount per month to ride the metro, that sort of thing, which is tax-free. But the way we do that is it's not out of pocket for us. We say, well, you can take a salary deduction and then we'll give you this tax-free credit. The secretaries at my firm apparently concluded that even if they didn't ride the subway, it would be foolish for them not to do this, even though it was a total economic loss for them to take advantage of this because they're going to not use it. And there were great debates within the secretarial ranks about this, and they completely reached the wrong conclusion. And I tried to tell one secretary, explain this. Why it was stupid to do for her, and she argued with me for 2 hours. So I don't think it has the incentive effects that you do because people have a hard time as it is just dealing with, for example, deduction phase-outs.
Were you able to bore for the 2 hours?
Lily.
Yeah, well, first on the fraud issue. So there's been a lot of discussion about the earned income tax credit, which is basically a work subsidy for low-income people having non-compliance problems. They have been fairly large. To some extent, they've been overestimated because a lot of the typical problem has been that the wrong person claims the child. So you get a much bigger earned income tax credit if you have children. And there's been some studies finding that even though the amount paid is wrong, the or to the wrong person, the net payments are not that off. The more important point I would make, though, is that compliance problems really depend on third-party reporting. So, for instance, the worst compliance problems we have are with cash-only businesses, where you have no way of verifying how much income they have. And with the earned income tax credit, you have these big problems with who's claiming the child, because we don't have a good way of verifying where the child is living half the year. If we converted a lot of other existing tax incentives to credits, I don't see any reason why we'd have a larger compliance problem, because you wouldn't really change the third-party reporting. So we do have third-party reporting on retirement accounts. We can or do on charitable contributions. We do on mortgage interest. So all of those, you wouldn't really have that problem of not being able to verify through a third party the key information that determines the size of the incentive. Your second question, on how responsive people. Yeah, sure.
Can I comment on that? I mean, the cheating on the earned income tax credit is some people underpay taxes when they can get away with it. Like a third of the noncompliance on the earned income tax credit is people who are self-employed, who also are notoriously underreporters of income under the regular income tax. There's no third-party reporting. There's not any reason to think that a refundable credit would be more or less prone to cheating than any other kind of tax incentive. Basically, if people, if you can save $10,000 on your income tax, and you don't feel a moral obligation to pay it, people will generally do that if they think they can get away with it. So it is specifically the design of the EITC particularly, and we actually don't know how much of it is errors and how much of it is deliberate fraud too. The program is just really complicated, and that gets back to the way the lawmakers designed it. They wanted to make sure that nobody got it who didn't meet any of 20 different criteria. And you could make it simpler. You could make it based on things the IRS could measure, and compliance would be very high, just like it is on wage withholding.
Mm-hmm. Then on your question about how responsive people are to incentives, I agree wholeheartedly that a lot of tax incentives people are not responsive to. My point was just that I'm not sure they would be any more responsive if it was direct spending program. So if we had a random subsidy for hybrid cars that existed temporarily that was going to be a check that you claimed from the government from a direct spending agency, I don't think there'd be a major difference. I have problems often with incentive programs, period. It's just, so I don't want to be misinterpreted as saying I'm a fan of incentives, but what I do think is that whether an incentive, if it is a good thing to have, and that's a big if, whether it is better run through the tax system or the direct expenditure system is kind of an open question.
Seeing no one else at the microphone and having run a little over our time, so our panelists have to run off and make for the door. Thank you all for your attention today. I hope that you've learned things that you didn't even know were to be learned before, and I hope that you will take action on what you've learned today and hold our lawmakers to account. You might think that the things that we've been talking about today are the best ideas or the best ways things possibly can be done, but I hope that you have had your eyes opened and that you'll act on the information that you have. Thanks very much for your participation today.